ESG and China to drive growth as fee pressure hits asset managers' high profit margins and continued risk appetite among investors will support the industry in 2020, according to Moody's Investors Service. Although under pressure from fee compression, passive product substitution and low organic asset growth, profit margins remain high for traditional asset managers, which is a source of credit strength, Moody's Assistant Vice President Stefan Kahandaliyanage wrote in a recent report on the global asset management industry. The outlook is supported by several factors including low expectations for a recession in 2020, further cutbacks in middle and back office functions which will compensate for increased spending on data, technology and regulatory compliance, and M&A activity, especially in the wealth management sector, that should provide economies of scale and diversification benefits. Asset management headwinds for 2020. Nevertheless, the industry faces headwinds. More fee compression is likely, especially for liquid products. Charges for commoditised funds, such as vanilla ETFs, will continue their march to zero, while regulatory moves towards greater transparency about fees globally will force fees on actively managed funds lower. According to Moody S. The tighter scrutiny of fund fees is reflected in the recent decision by Morningstar to place greater emphasis on fees in its analysts' ratings.Expense ratios have fallen on a continuous trend since 2013, although specialist funds, such as private equity and loan funds, have been able to maintain relatively high charges, noted Kahandaliyanage. For alternative asset managers, we believe business conditions, including low interest rates, public market volatility, and robust investor demand will continue support very strong profitability and leverage profiles across the sector, he said. Passive giants to drive AUM growth. However, poor returns from traditional active managers will lead to further encroachments from passive strategies, he noted. Net outflows accelerated in 2019 amid changing investor preferences and lack of performance among active equity managers, said Kahandaliyanage. Large passive players, such as BlackRock will, therefore, enjoy strong organic AUM growth rates, he said. According to Moody's calculations, average annual organic asset growth, excluding BlackRock, has declined 1.2% during the past 5 years, but has risen an average 1.7% a year if BlackRock is included. Total expense ratio decline for mutual funds and ETFs indexed to 2013 source, Moody's Investors Service. AI disruption in asset management. Meanwhile, technology disrupts all segments of the asset management value chain, said Kahandaliyanage. He expects greater use of artificial intelligence, machine learning and natural language processing to analyze unstructured or non-traditional data and identify perspective. For more on this story, visit the news article link.